Hey everyone, my name is Aman, I'm 21 and I'm a student of finance. And in this video, we're going to learn the importance of diversification, both in your equity portfolio and across asset classes. And in the end of the video, I'll show you if I had to create a new, fresh, diverse portfolio from 3 lakhs, how would I do it? So let's get started. So what is diversification? Diversification is the strategy of spreading your investments across asset classes, across different sectors, different geographic regions, to reduce your risk and to improve your potential returns. It's like putting your eggs in different baskets. To understand diversification, we need to understand the economic cycle. This is how an economy functions. The straight line is the real productivity. It is the real GDP. Waves around the straight line are the economic activity. It goes from trough to recovery to prosperity to peak and all over again. These waves are how everything functions. For example, how India's real GDP has been growing for a long time. This is the steady growth line. During this ongoing growth, we see bull markets making highs, bear markets making lows. We see low inflation growing into high inflation, then peaking and then going down again. This is also true with interest rates going from low to moderate to high and then repeat. The economic activity is cyclical. It moves in this waves-like pattern, and wherever we are on the economic activity line, it influences what sectors in the stock market will perform and what asset class are going to do well. As you can see, there is a trend as to what stocks do well in what part of the cycle. Close to the trough, the interest rates tend to be close to the lowest. This is when banks and other financial institutions do well, as low interest rates encourage people to take up loans. Banks can also borrow at very cheap. In the expansion phase, pretty much every sector performs and markets make new highs. And when it starts peaking, some fear is instilled in people. The inflation gets to an all-time high and precious metals like gold serve as inflation hedge. Sectors like FMCG, healthcare do well at this time as they are considered defensive sectors. They provide essential goods and services. You will have to buy groceries, soaps, medicines, be it high or low inflation. So this is why a diverse portfolio is essential. See, where are we on this economic cycle? We are in the early part of the downturn, somewhere close to this. If we look at the interest rates data, so they peaked and they stayed constant for a year now. And the Federal Bank, which is the Central Bank of the United States, basically the RBI equivalent of US, has begun cutting rates. And we too would have cut the rates, but inflation has spiked again. So we might see these cuts beginning by early 2025, hopefully. Now let's look at how asset classes do throughout this economic cycle. If the rates are close to the peak, I lock in my bond investments, corporate bonds, FDs. And during the recovery phase, you start maxing out your equity portfolio. And when you start seeing the market making new highs, booming, then you slowly liquidate your equity and rotate it into real assets like gold and crypto. This is how an intelligent investor makes money throughout the economic cycle. Another reason to diversify is to do with systematic and unsystematic risk. So what is systematic risk? So basically, systematic risk is the risk that is faced by the market as a whole. So for example, there is a flood in the country, or there's a war, or something that happens that leads to a massive crash in the market. Unsystematic risk is basically, for example, if you invest all your money in TCS or Infosys, and there is a company-specific issue, maybe to do with the management, or government brings out some regulation that only affects the IT sector negatively, then you have fallen prey to the unsystematic risk. Systematic risk is unavoidable, but unsystematic risk can be completely mitigated. How? By diversifying. By building a portfolio of 20 to 30 stocks, you can almost completely mitigate the unsystematic risk. So now you are making pretty much the same return, but the risk has gone down significantly. Now you can pause the video and take a screenshot of this graph, as this explains this concept very well. As someone from India, you should also have geographic diversification. Indian and US markets correlate close to 60 to 70%. And when you're investing in US indexes or US stocks, you get 3 benefits. One being capital appreciation. The Nasdaq 100 has a 20-year CAGR of 15%. 2. Currency appreciation. Every year the dollar appreciates against the rupee by 4 to 5%. Add that to the 15% CAGR, it becomes 19 to 20% year on year. And third is the diversification that you get from an index of another country. This investment into US indexes in my opinion, has a higher return to risk ratio. If I had to create a 3 lakh portfolio, this is how I would do it. 10% of the 3 lakh would go in debt, 70% in equity, 7% in crypto, and 13% in cash. And breaking them down further, the 10% which is debt, which comes out to be 30,000, 33% of that would be in bank FD and 67% of that would be in corporate FD. In equity, which is 70%, which totals up to 2.1 lakhs, 2 lakhs will be in Indian equities and 10,000 will be in Nasdaq 100 ETF. Within crypto, which is 7%, which totals up to 20,000, 50% of that will be in Bitcoin, 25% in Ethereum, 13% in Solana, 13% in Cardano, and in cash, this is 40,000, 13%. So the crypto, I have not spoken about crypto very much. And if you want me to speak more on crypto, do let me know in the comments. I'll make a separate video on that. I hope now you've learned the importance of diversification within an asset class and across asset classes, such that now you can build a portfolio yourself that will do well in every circumstances. If you did learn something new from this video, do press the like button. Thank you.